Management accounting and financial accounting often use cost information for different purposes, and understanding the difference between decision-making and profit reporting is an important concept within the program framework. Profit reporting focuses on preparing financial statements that comply with accounting standards and provide reliable information to external stakeholders such as investors, lenders, regulators, and shareholders. Decision-making, by contrast, focuses on providing relevant information that helps managers evaluate alternatives and improve organizational performance. As a result, the costs and revenues used for decision-making may differ significantly from those used for profit reporting. Understanding these differences enables management accountants to provide information that is appropriate for its intended purpose. Profit reporting is governed by accounting principles and standards that require consistency, comparability, and completeness. Financial statements must include all relevant production costs when calculating inventory values and profits. Consequently, absorption costing is generally used because it allocates both variable and fixed production costs to products. Unsold inventory carries a share of fixed production overhead, which is recognized as an asset until the goods are sold. This approach ensures that profits are reported according to accepted accounting standards and that financial statements present a fair view of organizational performance for external users. Decision-making, however, focuses on future consequences rather than historical reporting requirements. Managers are concerned with identifying the costs and revenues that will change as a result of a particular action. Therefore, concepts such as relevant costs, relevant revenues, contribution, and opportunity costs become more important than full product costs. For example, when evaluating a special order, managers may consider only the additional revenues and variable costs associated with the order. Fixed costs that remain unchanged are often ignored because they do not affect the outcome of the decision. This approach provides information that is more useful for operational and strategic choices. One major difference involves the treatment of fixed costs. Under profit reporting, fixed production overheads are allocated to products through absorption costing and included in inventory valuation. In decision-making situations, fixed costs may be irrelevant if they do not change between alternatives. For example, a factory's rent or depreciation expense may continue regardless of whether a special order is accepted. While these costs are essential for financial reporting purposes, they may not influence a specific managerial decision. Consequently, management accountants often use marginal costing and contribution analysis to support short-term decision-making rather than relying solely on full cost information. Another important difference concerns the treatment of sunk costs and opportunity costs. Profit reporting records historical transactions and reflects costs that have already been incurred. These costs are included in financial statements because they contribute to measuring past performance. In decision-making, however, sunk costs are irrelevant because they cannot be changed by future actions. Instead, managers focus on opportunity costs, which represent the benefits sacrificed when one alternative is chosen over another. Opportunity costs are highly relevant for decisions but do not appear in financial accounting records, highlighting a fundamental distinction between management and financial accounting perspectives. In conclusion, profit reporting and decision-making serve different purposes and therefore require different approaches to cost information. Profit reporting emphasizes compliance, consistency, and complete cost allocation through methods such as absorption costing, ensuring accurate financial statements for external stakeholders. Decision-making focuses on future outcomes and uses relevant costs, relevant revenues, contribution analysis, and opportunity costs to evaluate alternatives. Fixed costs, sunk costs, and opportunity costs may be treated differently depending on the objective of the analysis. By understanding these distinctions, management accountants can provide appropriate information that supports both effective managerial decisions and reliable financial reporting.